If you've never heard of forward testing, you are truly missing a key element to your trading journey. I strongly believe that this is the biggest single reason why 90% plus traders fail. That's not a catchphrase. That's based on actual evidence. The two examples that I cite all the time are that this process of backtesting, forward testing, reviewing, and having iterations of your trading strategy as you refine edge on it, this is how the pros do it. This is how institutions do it. This is how big funds do it, hedge funds. This is the basic framework of how to learn to trade, how to build edge. Mark Douglas talks about it in Trading in the Zone. He says the very first thing you need to do is build a statistical edge. So that's what we're doing here with forward testing is we're building a statistical edge. What's the difference between back testing and forward testing? Not much, actually, but there is one key thing that makes it far more effective than backtesting for short-term strategies. It's that you're paper trading that strategy. You're trading it just the way you would trade it. When you're backtesting, you see the way that it played out. And you can, I mean, no one, not even me, nobody can backtest it exactly the way they would have traded it because there's so much more going on in the moment than just the chart. In the moment, you've got news and macro and candles are moving and there's, less information available in the moment. And so you're just going to trade it the way that you think is best in that moment. When you have recorded that information of how you trade it and you go back and see what would have worked if you actually did sell too soon, if you should have taken that entry when you thought you did, but you hesitated. You can see all of those things when you go back. Let's bring up an example. Now, when you backtest for real, you're not going to just have three occurrences, three trades in there. You want at least 10 trades. Because what happens in one trade, no one knows. I don't know what's going to happen in one trade in my trading strategy. The best traders in the world don't know what's going to happen on the very next trade that they take. The key is to know what's going to happen over 10 or 20 or 50 or 100 trades. That is much more definable, and that's what we're doing with forward testing. And you may recognize that from back testing. It's the same idea. It's just you're introducing what you see in the trades into the test, which is key. It's everything. So I've got this forward test. I just did a couple of occurrences here. This is just a simple trend following strategy where we're looking to dip by pullbacks. So we've got a pullback, and when it breaks that trend line, that's an entry. And we're going to ride it up. And at this point, if you're just starting out and you're new to forward testing, this is all you know. You don't introduce RSI, you don't introduce moving averages or ATR, nothing like that. From day one, you just want to start with the simple entry, exits, support, resistance, trend lines, breakouts, whatever it is that you're trading, just the most basic parts of the strategy. Start there first. So that's what we have pulled up on the chart here. And I've recorded this trade right here. We had a pullback. We didn't make it all the way back to the trend line. I mean, we did here, but that's not the strategy. The strategy was to take the breakout when it breaks this trend line. So we recorded it at 6:12:20. So right about in here, right about where it opened. And we went ahead, we stayed in the trade. I know this seems like a back test. In reality, you would be doing this in real time and you would have forwarded to. So there's a little bit of imagination here. There are some limitations to what I can show on YouTube, as you can well imagine. I can't show an 8-day trade as part of this. Even if I was day trading and I tried to show a 20-minute trade, it would just make too long of a video. So let's just say that I went ahead and I traded this, I paper traded it. Like I said, I took an entry here, and let's say I got shaken out, say right here somewhere. 622.80 is what I recorded because when I traded this for real, I got shaken out on this red candle. So still a win. Still, we recorded it on the spreadsheet. By the way, this is a free spreadsheet. I call it the back test tool, but the truth is, as far as recording it on a spreadsheet, there's really not much difference in the spreadsheet between a back test and a forward test. And in fact, when I do my forward test, if I'm starting with a new strategy, I back test it on a spreadsheet similar to this, and then I just go ahead and start paper trading it, and I carry the back test on and just continue adding trades to it because, more occurrences can't hurt, right? So I went ahead and got shaken out. I got about a 1 to 1.5 risk to reward because of that, and I recorded it as a win. What can I tell from this one single trade? Not much. Not much at all. Can't tell much because anything can happen on one single trade. Again, reference to Trading in the Zone. If you haven't read Trading in the Zone, make sure to read that book. That's a key book. Next occurrence happened right here on December the 19th. We had a pullback and we went ahead and broke that trend. So we recorded an entry at 6:14:10 right about here. I didn't record it right at the open because if I was in a real trading situation and this gapped up above this red line, I'm not entering at 8:30. I wouldn't do that. I'd want to see how the day plays out. So let's say I enter around noon or something like that. So that's why I recorded at 6:14:10. Recorded our stop loss just below this support level here at 6:06. And we went ahead and took an exit at 6:17:52. Let's see what happened here. So what happened is we started moving up in the direction of the overall trend, which is what we were looking for. And then we had a down day. So when we had that down day and a second red day, we went ahead and just took the trade off. So in that case, we only got a 1 to 0.04 risk to reward. So everybody wants to get a 1 to 2 or a 1 to 3 risk to reward, and you're going to backtest your strategy that way. You're going to set it all up, and then reality hits, and you actually trade it, and you end up with this less than a 1-to-1 risk to reward. That's not good, is it? So then on February 20th, we had another occurrence that was right in here. And we took the trade at 6:10:50 and we put our stop loss at 598, which is just below this support level, little micro support level there. And we got stopped out a few days later. So out of this, we got 2 wins and 1 loss. Like I said, if you're doing this for real, you want to record 10 trades, but this is just an example of how to look at a forward test. So that's, a 66% win rate. Our expected outcome was zero point 0.3. If you're not familiar with this, if you download this free spreadsheet here, I explain what these metrics are and what they do. You can click on the note, or I guess hover over the note. But long story short, expected outcome is if you're risking $1 on a trade, so for every $1 that you lose on a trade, you need to make at least $1 to pay for that losing trade. So if I'm winning more than I'm losing in both win rate and risk to reward, then I should be making more than I'm losing, right? So after I take the $1 to pay for the $1 loss, How much extra do I have left over? That's what expected outcome is. It says here 30 cents. So I'd have 30 cents left over after I pay for all my losses. Let's go down here. I developed this chart to show you if this is like a hedge fund or especially a bank would think that this 30 cents is great. They would think that's awesome. That's exactly the kind of strategy that they're looking for. Because if they place 5 trades per week and get this expected outcome after they pay for all their losers, they can make 75% on their account, given, 1 to 2% risk per trade. So they think that's great. For retail, we probably are wanting to push it more to 0.5, zero point 0.8, or even 1. There is even people out there who push it over 1 and are able to get more. Um, but what I'm really getting at here is look at the information that you get. Even if you just test 10 trades, forward test, 10 trades, all of a sudden you can see I wasn't always getting my risk to reward. My profit or my expected outcome, it doesn't look like much, but actually with the amount of trades that I'm making, that's not a bad strategy. That's not completely terrible if I do have the amount of opportunities that I think I have every week. When you go back and look at the charts here, you can see things like, hey, I got shaken out here. This might have went a little more, you could make a decision based on your risk tolerance. Is this something that I might have held for longer? Did I sell too soon? Or over 10 trades? Because, so here's a great example. Everyone has the trade that they sold and then it went like way more. It went like so much more. It doubled or tripled from where they expected or where they took their profit compared to their risk. So everyone has those trades and they all beat up on themselves like, oh, I sold way too soon. How do you know you sold too soon? How do you know? Well, this is how you forward test. So do I still feel like I sold too soon here, having seen where the chart played out, having seen where the chart played out on the next several trades, over 10 trades, would I have sold too soon? Or is that just the nature of this trading strategy on this instrument? And therein lies the key, finding out what the nature is of that strategy on that instrument, especially under certain market conditions. When you start to understand those things, when you start to understand what you see in the charts that you could have done better, do you see right here? I said, well, we didn't get all the way back to the major trend line. Well, actually, we did. We did get all the way back to the major trend line. It's just that that's not when the break of the short-term reversal was. So is this something that you look at here and say, if I get within, a hair of this trend line, or maybe even I break a little bit through, maybe I take a half position. Maybe that's something I want to do. You can't know this kind of thing from one trade at a time. If you're only looking at the trade that you made that day or that week, you can't know this stuff. But over the course of 10 trades, seeing what's common, we saw here, well, we got pretty close again. At some point, I may have wanted to take a half position. And here we got pretty close. I may have wanted to take half a position. All of a sudden, maybe my strategy changes and I'm just getting rid of these lines. I'm like, yeah, I don't care about these lines anymore. Don't even want them there. Because every time that the price comes down close to this trend line, that's the best opportunity. You have to figure out what makes sense for you. And the best way to do that is by actually trading it, recording it in a spreadsheet, the way we've shown here, and then going back on the charts and analyzing it, seeing what would have worked, what would have worked better. Did you actually sell too soon, Or was it just that one time out of 20 trades when when the price ran way, way higher than you expected? And all the rest, the other 19 times it didn't do that. And you would have been best to take profits where you had initially taken profits. And now, do you see how this can help you so much with your psychology? Because people have FOMO, fear of missing out. But hey, when I know I'm taking this trade, when it breaks that trend line, there's a lot less fear of missing out. Like, I'm just like, I'm not even worried about this. I set an alert on this trend. The alert goes off, I buy. End of story. I already know how it typically works out for me. I already know that if it works out typically, then I will make 30 cents after I pay for all my losers. And I know that if I make 30 cents on average across 5 trades per week, then I can make 75% on my account in the year. So the three basic steps to forward testing are once you have your strategy and you kind of know the basic rules of it, the three steps are paper trade it and record all of your trades. The next step is to go back on the charts and review it. See what you could have done better. Did you follow the strategy? Did you actually have FOMO, or was that just kind of the way things work out? Was there something on the chart that you can clearly see that would have made this strategy a lot better? Take that information, do the third step, refine. Do 10 more trades using that refined criteria and see how it works out on the next 10 trades. If you just keep doing that over and over and over again, you will build edge. So, and I talk about that in other videos, right, guys? We don't find edge. You don't find edge. Edge isn't given to you. You don't get it from a YouTube channel from some mentor or guru. Um, you don't buy edge. You can't buy a course and that buy a strategy that comes with edge. This is how you build edge because edge is personal. You have to build it yourself based on what you see in the charts. I hope you got some value out of this. If you did, leave a comment. This really is just the beginning of a journey for you. I do strongly and firmly believe that everybody needs to go through this process of forward testing and building edge on their own. Whether you're a day trader or a swing trader, it doesn't matter. I do firmly believe this based on what the professionals say and the information that's out there and my own personal experience as well. So I've made myself available on Reddit at Traders Edge Labs. I started a sub there so that we can talk about this. I'm sure you'll have questions if you're interested in this and you're finding some success with it, you see the value with it. I'm sure you'll want to find me, ask me more questions. I can help you to go through this process and start to develop real edge.